But Tesla's been under the gun here. Do you have data supporting maybe this pullback, or is the market getting this wrong?
We saw price cuts from Tesla in the fourth quarter. That will have a direct impact on those gross auto margins.
Melissa, this was the most sobering outlook that I have seen from Tesla when they talk about a step down, a notable step down in growth rates.
We begin tonight with some breaking news. Tesla investors are losing a little bit of money right now.
All that and more. So let's get to it. Oh boy. Tesla stock is down in the pre-market over 7.5%. Year to date, Tesla is currently down over 22%. But this plateau right here, that's what we're going to focus on today instead of having Tesla Throwback Thursday. Honestly, I expected the stock to dip, but not at this magnitude. I've been forced to play this rather odd. In the beginning of the year, I expected Tesla to soar to new heights. Boy, was I mistaken. Instead of doubling down on my conviction that the stock market would actually realize Tesla's true value, I pivoted, placing a put that expires on the 26th. The break even on this thing was 205.20. Yeah. I'm not a very greedy man, so at the opening bell, I will take my returns at damn near 200%, using half of those proceeds to buy Tesla at this extremely discounted price. Let's recap the events that has led to Tesla dropping nearly 8% in the pre-market after what I viewed as a pretty decent earnings call.
Off a little bit. I think this is about contracting of margins, maybe some demand issues. They hit their target, over 1.8 million cars delivered last year, but Tesla's been under the gun here. Do you have data supporting maybe this pullback, or is the market getting this wrong?
When I think about Tesla, I've been thinking about Tesla long term since about 2016 or 2017, pretty bullish on it throughout, continue to be bullish on it. I think that the near-term challenges to Tesla are very real. Some of it is just simply the law of large numbers. It's really difficult to continue to grow at the pace that Tesla has grown over the last decade once you hit these types of levels.
But even at a run rate of about 2 million vehicles per year, Tesla is going to experience some unique challenges, especially as they ramp and retool factories around the world. Introducing new projects like the Cybertruck or Optimus or the next generation vehicle will pose challenges to their manufacturing process. We experienced this in Q3 when they had to apply a little downtime to the factory. Something tells me that we'll be in line for more of the same here in 2024.
But overall, like Folio data, very strong for Tesla, especially when you just zoom out. Tesla.com, which has been a very good indicator of purchase plans, up nearly 50% year over year. I think this is directly related to the pricing strategy of the company. The prices have gone down numerous times over the past year. We continue to see increased demand for Tesla cars, and I guess you could throw the word truck in there now that the Cybertruck is on its way. So overall, I think Tesla is absolutely in the driver's seat. I think it's time to take them out of the EV bucket and put them simply in the automotive manufacturer bucket. This is a company that's competing with all car manufacturers now. The race to be best in EV is completely over.
He ain't never lying, folks. Even though people want to claim that BYD is the new... Get the out of here with that nonsense. Let's be real. BYD is limited to China. They have some exposure in Europe and Mexico or whatever, but they're limited there in China. Tesla is a global company with growth on the mind.
And now Elon Musk is talking about a cheaper, a less expensive production model here. Isn't the street just getting it wrong? It's not that they're avoiding EVs. When someone buys an EV, they buy a Tesla, not the others.
Yeah, exactly right. I think the whole EV story, and especially Ford slowing down production, other car companies slowing down production of EVs, is, I think you're right. It's more of a story of just how strong Tesla's dominance is. When Tesla rolls out a $25,000 or $30,000 vehicle, I don't think that the world's really prepared for what that could mean.
Ding, 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 ding. Tell him what he's won, Johnny. Your mother right. I can talk until I'm blue in the face about how much this is going to be a game changer, but Tesla is being very, very careful with this product release. They don't want it to fall in the category of the Cybertruck as better late than never, but one thing's for certain, when Tesla does get this right, everybody else is going to be caught with their pants down.
Pressure is on for Tesla to deliver. What kind of number are we looking for, and where will the biggest buyers of Teslas be?
I think the number that the investors are particularly going to hone in on tonight is going to be the profit margin at Tesla, and particularly automotive gross profit margin.
The one number that everybody's going to be focused on, Carl, and we talk about it every quarter, gross auto margins excluding zero-emission vehicle credits.
Ooh, the margins. Of course, that's going to be the number that most people will focus on. What are the margins? Are they going up? Are they going down? It's irrelevant to the growth story, but it's nice water cooler talk.
That number has been coming down at a pretty steady clip over the last couple of years. Look at the estimate for the fourth quarter, 15.7%. Back in the first quarter, it was up at 19%. Hey, a couple of years ago, I remember when it was well north of 20%. And the reason is because of what's happening in China. It is the world's largest EV market. It's a huge market for Tesla, understandably. They've got the Gigafactory in Shanghai. The pricing pressure there has been immense, and it has not let up. We saw price cuts from Tesla in the fourth quarter. That will have a direct impact on those gross auto margins. In terms of deliveries, the street wants to know if they're going to give us guidance for 2024. Remember, Tesla delivered just over 1.8 million vehicles last year. The consensus right now going into the call today is 2.1 million is what they're expecting Tesla to give.
Yeah, so this is a big scoop here by Reuters on the day of earnings, right? This reporting of this mass production of this cheaper $25,000 EV, possibly their Gen 2 car they had mentioned in the past, like I said, codenamed Project Redwood internally. Production, of course, potentially starting mid-2025, which is pretty aggressive, kind of have to get that tooling in place for that, a big rollout. And they want to do, I think, around, the sources told Reuters, around 10,000 units a week. So that's a pretty big mover, and it would start production potentially at Austin. My understanding is that, could this be a car that's also the robotaxi? Would it be a second car, two different cars? The sources told Reuters it could be two different or multiple cars with the platform. So
one car with a steering wheel and pedals, one car without.
17.6%, and when you adjust here for those regulatory credits, 17.2%.
Yeah, and it's important because automotive gross margin, X those credits, slightly above what were muted expectations. Tesla still has industry-leading margins for making electric vehicles. But in the final 3 months of 2023, discounting price cuts, using that lever in both directions was a factor, along with, despite it being a record quarter in terms of sales, an impact on the bottom line, which they've kind of stayed the course on.
Well, we addressed the margins, and they came in pretty high. However, Tesla did miss on the market expectations on the top and the bottom line. I would say they came more in line with expectations. I kind of knew that the margin number was going to be relatively decent. It's the estimated volumes of 2024 that honestly has me a tad bit concerned.
I want to go to something that Tesla said, which makes it really difficult to understand what's going on, which is that volume growth will slow notably. That's pretty vague, and we know that for 2023, they delivered a record 1.8 million vehicles, and a lot of analysts were anticipating something in the neighborhood of 2.2 million vehicles for this year. What does it mean when Tesla has talked so much about a 50% annual growth rate in deliveries?
What's critically important to state is that 50% CAGR, which goes back to early 2021, starting from the end of the 2020 financial year, related to production. So what they're saying on a compound average annual growth basis is that they would increase their production capacity and the number of vehicles they built by 50%. They built more than 1.8 million in 2023. Had they maintained that 50% CAGR, they would have been on track to build 2.5 million in 2024. But they're saying the opposite. A, they're not giving us formal guidance. They've omitted that from the volume, the graph in the deck titled volume. But what they're saying is that while they're ramping up their first-gen models, Y and 3, they also have imminent plans to bring on this next-gen model that we have few details about, which will be built in Texas.
Not first-gen, those are third-generation vehicles. Next-gen will be the fourth generation.
And for that reason, they're guiding us to substantially lower growth. But that growth, again, it is on a compound basis, and it's based on production, not delivery. But you can extrapolate out, right? And if they build less cars, they have fewer to deliver to customers.
That information right there lowers my expectations for Tesla's production and deliveries for 2024.
What is your take on the quarter and your reaction to the stock move?
Melissa, this was the most sobering outlook that I have seen from Tesla when they talk about a step down, a notable step down in growth rates. I just want to put that in perspective. The street was looking for 19% revenue growth in 2024 for this year, and they said it'll be notably lower than that. So it probably comes in at 10%. When I see that, I think stock's down 5–10%. That was my initial reaction. I'm surprised to see where it is. The reason why I believe it's holding in is twofold. You highlighted the importance of the gross margin X credits. I would just add to that, that's the first time in a year that we've seen that improve. And so that is a surprise on the positive side, especially given the ramp of Cybertruck, some of that investment. And second, I think the stock reaction speaks to the conviction of shareholder investor base. And effectively, this comes down to a very simple question, is do you believe that EVs are the future? And if the answer is no, that you think that this is going to take 20 years to get to electrification and autonomy, then you believe the stock should be down measurably, meaningfully, 10% more on this news. But if you do believe in the future, then this punky, soft guidance that they're giving for this year is going to ultimately prove to be noise, because everything that Tesla's doing, building out this next generation vehicle platform, everything that they've done in their investments in autonomy, all of that is coming at a time where traditional auto is stepping back from these. And so that's the question. If you believe in electrification and autonomy, Tesla's actually in a better position longer term. And I think that the reaction to shares speaks to the conviction, long-term conviction that Tesla shareholders have.
Gene is absolutely right. Either you believe that EVs and autonomy are the future, or you don't. Now, Tesla stock has dropped considerably since Gene's comments aired on CNBC, but if you're looking long term, you've got to be licking your chops to buy Tesla at these muted levels. I know I am.
Can you help us understand, Gene, what this next-gen vehicle platform is and what that gives Tesla in the long term? I mean, we may see that step down in volume growth this year, but on the other side of that, if we see increased efficiencies, if we see increased output, this could just, you could smooth this year over and see the trajectory higher.
You'd see an acceleration back potentially. I mentioned the 10% for this year, but next year could be 30% plus growth. And the specifically is that this is a lower price vehicle, likely around a Honda Accord. A typical Honda Accord in the U.S. starts at $30,000. That's below the average selling price of a car in the U.S. at $48,000. And it's likely going to be a couple vehicles. One is a lower price car with a steering wheel, and then followed by a robo-taxi. And
so I've always had trouble with, how do you value Tesla then? Put it all together. How do you come out with a valuation for Tesla?
So what I look at is where the revenues are going to be in 3 to 5 years. I want to revisit it after the call here, but
you and me both, Gene. You and me both.
Think about what that revenue growth is going to be. I mentioned a step back up to 30%. And then I go and look at what other companies are trading at. The best comp is Apple. When it comes to hardware, software, services, I think that's most representative of Tesla. And so that's a 6 or 7 times multiple. And so when I put those two together, I can comfortably get to above a $1 trillion market cap for kind of that 5-year period. Again, I want to see what's going on with their commentary on kind of long-term growth. But that's how I get there, as I think about this as a revenue multiple relative to where the revenue is going to be in 3 to 5 years.
We begin tonight with some breaking news. Tesla investors are losing a little bit of money right now. Stock is down. Tesla tonight warning that this year's sales growth will be less than it was last year. Some big money investors, they may have anticipated this news. Tesla's down 16% so far this year, but as always, context is key. Investors nearly doubled their money in Tesla last year. All right, that being said, let's get more on everything we know about Tesla's last quarter and what may be ahead from here. Phil LeBeau listening in on Tesla's earnings call. It ended a short time ago. Phil, what were some of the takeaways?
Good news, bad news in terms of the fourth quarter, and not such great news in terms of the outlook. Let's start first off with the fourth quarter. It was a miss on the top and the bottom line, not by a lot. 71 cents a share earnings versus 74 cents a share earnings estimate. The gross auto margins, now this is the good news last quarter. They improved, went up to 17.1%. The street was expecting 15.7%. By the way, that's an improvement, 17.1 versus 16.3 in the third quarter. But the outlook for 2024 deliveries, they didn't give a guidance. They didn't give us a number. They simply said notably lower. Why? Because they are transitioning and preparing to ramp up next generation vehicle production starting at their Gigafactory in Texas. Here's Elon Musk a short time ago.
The first manufacturing location for this will be at our Gigafactory and headquarters in Austin, Texas. And then we'll follow that up with other locations around the world. Probably the factory we'll build in Mexico will be second, and then we'll be looking to identify a third location, perhaps by the end of this year or early next, outside of North America.
He thinks they might be able to begin production. It's scheduled to start second half of 25. Keep in mind that that's just a projection at this point. This is the other thing that spooks investors right now. They delivered 1.8 million vehicles last year. The street was expecting them to give guidance of at least delivering 2.1 million vehicles. There was no guidance given. They end the year 2023 as the number one EV automaker in the world. They are number one in EVs, but that crown is starting to erode a little bit. Why? Because you've got Chinese automakers, in particular BYD, nipping at their heels. BYD, by the way, topped Tesla in the fourth quarter, not for the entire year, but in the fourth quarter. And Elon was asked about the growth of Chinese automakers and their growth around the world. Here's what he had to say.
The Chinese car companies are the most competitive car companies in the world. So I think they will have significant success outside of China, depending on what kind of tariff or trade barriers are established. Frankly, I think if there are not trade barriers established, they will pretty much demolish most other car companies in the world. So they're extremely good.
We have talked about it for months. We were over in Europe showing the growth of Chinese automakers over there. They are coming, and coming on strong. Now, whether or not you can say, well, that's the reason Tesla is not giving guidance for next year, that's too much to say. The bottom line is this. Tesla is facing a slower EV market worldwide, and they are trying to transition to this newer, lower-cost next-generation vehicle that they, at this point, Brian, are projecting to begin production on in the second half of 2025.
In conclusion, so much Tesla news, it's hard to digest it all. I thought the call was great. I thought the numbers were in line with my expectations. 17% is where I assumed Tesla's margins would be. But there's no denying that Tesla had a negative reaction in the stock market. Such vague guidance when it comes to production volumes? My Tesla valuation model is predicated on how many cars that Tesla is able to produce and deliver. Over 90% of their revenue comes from automotive sales. It's hard to ignore, as it funds these other projects, FSD, Optimus. Nobody is talking about the burgeoning energy division that's going to help supplement some of these revenues. Tesla is more than just an automotive company. That's all I have for you today. Be easy.